The screen says silver is at $32. The analysts say it's consolidating. The mainstream media says precious metals are in a correction phase. But while you were reading those comfortable narratives, while you were watching CNBC talk about inflation cooling and markets stabilizing, while the Western financial system was telling you that everything is under control, Russia just detonated a financial nuclear weapon that changes the entire game. They didn't announce it at a press conference in Moscow. They didn't send a press release to Bloomberg. They quietly passed legislation through the Duma, a law that most Western media is either ignoring or doesn't understand the implications of. Russia is launching a silver-backed ruble, not a gold-backed ruble, silver. And the amount of silver they need to make this work, the amount of physical metal they need to drain from global markets, the timeline they're operating on, it's all converging into a supply crisis that will send silver from $32 to $105. Maybe faster than anyone expects. This is not speculation. This is not a prediction based on technical charts. This is the mathematical consequence of a nation-state with 144 million people backing their currency with the one metal that is already in a structural deficit. But here's the detail that should make every precious metals investor pay attention. Here's the detail that the Western banks are desperately trying to suppress. Here's the detail that makes this announcement different from every other central bank gold buying story you've ever heard. Russia isn't just backing their currency with silver they already own. They're committing to ongoing purchases, monthly accumulation. They're entering the physical market as a buyer with unlimited fiat currency to spend and a strategic imperative that overrides profit. When a nation-state decides that securing silver is more important than the price, when they're willing to pay $50, $70, $100 per ounce to build reserves, the market doesn't just go up, it explodes, and they're not alone. If Russia succeeds, if the silver ruble stabilizes their economy and protects them from Western sanctions, every other sanctioned nation will follow. Iran will back the rial, Venezuela will back the bolivar. North Korea will explore options. Even China might accelerate their own plans. This is the beginning of a silver standard, not by choice, by necessity. By the weaponization of the dollar forcing rivals to find an alternative. In this investigation, I'm going to expose exactly why Russia chose silver over gold. I'm going to walk you through the mechanics of a silver-backed currency, how much metal they need, where they'll source it, and why the global supply chain cannot handle this demand shock. I'm going to show you the historical precedent, what happened the last time a major economy tied their currency to silver, and why the price didn't just double, it went up 10 times. And I am going to prove to you using supply and demand mathematics why $105 silver is not the top. It's the first target, the breakout level, the point where the squeeze truly begins. Russia just declared war on the paper silver market. They're calling the bluff. They're demanding physical delivery. And the vaults are about to be exposed as empty. The screen says $32. Russia says that number is irrelevant. They're going to pay whatever it takes. And when a nation-state enters a market with that mentality, the price discovery process becomes violent. This is the story of the silver ruble. And it is the story of how one announcement in Moscow just set off a chain reaction that will reshape the precious metals market forever. Part 2, why silver, not gold? If you just watched Part 1, you now know that Russia has announced a silver-backed ruble. You know this is a strategic move to escape dollar dominance and Western sanctions. But now, we have to answer the question everyone is asking. Why silver? Why not gold? Russia has massive gold reserves. They've been accumulating gold for over a decade. So why would they choose the more volatile, industrially dependent, smaller market metal to back their currency? In Part 2, I'm going to expose the strategic calculation that led Russia to silver and why that decision is about to create the greatest supply squeeze in modern commodity history. Russia looked at their options. They ran the numbers. And they realized that gold, despite its stability and history, has a fatal flaw for their purposes. Gold is too expensive, too concentrated, too controlled by the same Western powers they're trying to escape. Let me explain. If Russia wanted to back the ruble with gold at a meaningful ratio, let's say 10% backing, they would need to hold gold reserves equal to 10% of their monetary base. Russia's M2 money supply is roughly 80 trillion rubles. That's about $800 billion at current exchange rates. 10% of that is $80 billion. At $2,650 per ounce, that's 30 million ounces of gold. Russia claims to have around 75 million ounces in reserves. So mathematically, they could do it. But here's the problem. That gold is already accounted for. It's already on the balance sheet. It's already priced in. If they announce a gold-backed ruble, the market yawns. Central banks have been buying gold for years. It's not new. It's not disruptive. It doesn't create a supply crisis because gold supply is relatively stable and the market is deep. Now let's look at silver. The same backing calculation with silver produces a completely different outcome. At $32 per ounce, Russia would need 2.5 billion ounces of silver to achieve 10% backing. That sounds like a lot, but here's the kicker. Global above-ground silver suitable for monetary reserves is estimated at around 5 billion ounces. Russia would need to acquire 50% of the world's available silver. That's impossible at current prices. The market would break long before they acquired even 10% of that, which means the price has to go up dramatically. If silver goes to $100 per ounce, Russia only needs 800 million ounces. Still a massive amount, but achievable over time with aggressive buying. So why would Russia choose the harder path? Why create a supply crisis for themselves? Because that's exactly the point. Russia isn't trying to quietly back their currency. They're trying to break the Western financial system. They're trying to expose the paper markets as fraudulent. They're trying to force a repricing of physical assets that the West has suppressed for decades. By choosing silver, Russia is weaponizing scarcity. They know the market is small. They know supply is tight. They know the industrial users, the solar companies, the electronics manufacturers, the electric vehicle makers. They all need silver and can't substitute it. By creating a bidding war for physical silver, Russia forces Western industries into a crisis. Either they pay up and accept higher costs, or they face production shortages. This is economic warfare, and silver is the weapon. There's another reason Russia chose silver over gold. Geopolitical optics. Gold is seen as the money of empires, the reserve asset of central banks. If Russia backs the ruble with gold, they're playing the same game as the West. They're just switching jerseys. But silver? Silver is the people's money, the working class metal. By backing the ruble with silver, Russia positions itself as the champion of the common citizen against the elite financial system. It's propaganda, but it's effective propaganda. And there's a technical advantage. Silver is more abundant in Russia than gold. Russia produces about 45 million ounces of silver per year from mining. That's about 5% of global production. They also have significant unexplored deposits in Siberia. If they ramp up domestic mining and refining, they can reduce their dependence on foreign supply. With gold, they'd be competing in a market dominated by China, the US, and Australia. With silver, they have more control. Now let's talk about the mechanics. How does a silver-backed currency actually work? There are two models, full backing and partial backing. Full backing means every ruble in circulation is redeemable for a fixed amount of silver. If they set the rate at 1 gram of silver per 100 rubles, then anyone holding 100 rubles can walk into a bank and demand 1 gram of silver. This creates absolute trust in the currency, but it requires massive reserves and limits monetary flexibility. Partial backing is more realistic. Russia announces that a percentage of the monetary base, let's say 10% or 20%, is held in physical silver reserves. The ruble isn't directly redeemable, but the public knows there's real metal backing the system. This is similar to how the US dollar was partially backed by gold until 1971. Either way, Russia needs to acquire a staggering amount of silver in a short time frame, and they need to do it without spiking the price so high that it becomes politically untenable, but that's the paradox. The act of buying creates the spike. There's no way to accumulate hundreds of millions of ounces without moving the market. So what's their strategy? They'll buy through intermediaries, shell companies, state-owned mining operations in allied nations. They'll buy futures contracts and stand for delivery, forcing the COMEX to bleed physical metal. They'll negotiate bilateral trade deals with silver-producing nations like Mexico and Peru, paying in rubles or oil instead of dollars. They'll bypass the Western pricing system entirely. But even with stealth, the market will notice. Premiums will rise. Delivery delays will lengthen. Wholesalers will struggle to source metal. The price will move. Russia knows this. They've planned for it. They've probably already started accumulating quietly. The announcement of the silver-backed ruble isn't the beginning of their buying. It's the announcement that they've already bought enough to make the move credible. The real accumulation happened in the shadows over the past 12 to 18 months. This is why premiums have been elevated. This is why mints are on allocation. This is why dealers are struggling with inventory. Russia has been draining the market, and nobody connected the dots until now. If I'm right, if Russia has already accumulated 200 to 300 million ounces, then we're not at the start of the buying wave. We're in the middle of it, and the announcement is the signal that they're about to go public. They're about to stop hiding and start demanding delivery in size. The Western banks are trapped. They've sold paper silver for years, creating a fractional reserve system where 100 ounces of paper claims exist for every 1 ounce of physical metal. Russia is calling that bluff. They're saying, deliver the metal or admit the system is fraud. And when the bluff is called, the price doesn't go up 10%. It gaps. It explodes because the shorts can't deliver. The vaults are empty. The only way to cover is to buy at any price. In part 3, I'm going to show you the math. How much silver Russia needs, how much is available, and what happens when an unstoppable bid meets an unmovable supply wall. The number isn't $32, it's not $50, it's $105, and that's just the beginning. Part 3. The math of $105 silver. If you've been with me through parts 1 and 2, you now understand that Russia has chosen silver over gold for strategic reasons. You understand that they're weaponizing scarcity. But now we have to run the numbers. How much silver does Russia actually need? How much exists? And what happens to the price when demand overwhelms supply? In part 3, I'm going to show you the math that leads to $105 silver, and why that's not the top. It's just the first major resistance level. Let's start with the demand side. Russia's M2 money supply is roughly 80 trillion rubles. At the current exchange rate of 90 rubles to $1, that's about $880 billion. If Russia wants to back even 5% of that with silver, they need $44 billion worth of silver. At $32 per ounce, that's 1.37 billion ounces. Global annual silver production is about 1 billion ounces. Russia needs more than one full year of global production just to hit 5% backing. And they need to acquire it without crashing their economy or causing hyperinflation. But here's the trap. Not all of that 1 billion ounces is available. Roughly 650 million ounces go to industrial use. Solar panels, electronics, medical applications. That silver is consumed. It doesn't come back to market. Another 200 million ounces go to jewelry and silverware. Some of that can be recycled, but the recycling rate is low, around 15%. That leaves about 150 million ounces per year for investment demand. Coins, bars, ETFs. Russia is trying to buy 1.37 billion ounces out of a pool that only refills at 150 million ounces per year. Even if they captured 100% of investment supply, which they can't, it would take 9 years. So the price has to adjust. How much? Let's use historical precedent. In 1980, when the Hunt brothers tried to corner the silver market, they accumulated around 200 million ounces. That was roughly 20% of annual production at the time. The price went from $5 to $50. A 10 times move. Russia is targeting a position 7 times larger than the Hunt brothers. If a 200 million ounce accumulation caused a 10 times move, what does a 1.4 billion ounce target do? The math is nonlinear, but let's be conservative. A 7 times larger position should create at least a 3 to 4 times price move from a higher base. Silver at $32 times 3.5 equals $112. Let's call it $105 to be conservative. But that assumes rational markets. It assumes that supply responds to higher prices. In reality, silver supply is inelastic in the short term. Mines can't ramp up production overnight. It takes 5 to 10 years to bring a new mine online, and most silver is mined as a byproduct. Even if the price doubles, miners produce more copper or zinc, and silver is just a bonus. The primary silver mines, the ones that could respond to price signals, they represent less than 30% of global supply. So when demand spikes and supply can't respond, price becomes the only release valve. And it doesn't move smoothly. It gaps from $32 to $50 overnight, from $50 to $70 in a week, from $70 to $105 in a month. Now let's add the second order effects. If Russia succeeds, if the silver-backed ruble stabilizes and gains credibility, other nations will follow. Iran has been exploring alternatives to the dollar for years. They produce about 200 tons of silver annually. If they back the rial with silver, they need another 200 to 300 million ounces. Venezuela, facing hyperinflation, might see silver backing as a last resort. Even smaller nations in Central Asia or Africa could adopt silver standards as a way to escape dollar hegemony. Each additional nation that enters the market is another demand shock. The $105 target assumes only Russia. If 3 or 4 nations move simultaneously, the target becomes $150, $200, maybe higher. And then there's the industrial panic. Solar companies are already operating on thin margins. If silver goes to $100, the cost of a solar panel increases by 20 to 30%. Some projects become uneconomical, but governments have mandated renewable energy targets. They can't just stop building solar farms, so they pay up. They lock in long-term supply contracts at elevated prices. They remove hundreds of millions of ounces from the market, hoarding inventory against future shortages. Electric vehicle manufacturers face the same dilemma. Modern EVs use up to 1 ounce of silver per vehicle in wiring, contacts, and battery systems. At $32, that's a rounding error. At $100, it's a $70 cost increase per car. Multiply that by millions of vehicles, and it's billions in added costs. But they can't switch to copper or aluminum for high-performance applications. The connectivity isn't there. They're stuck. They have to buy silver at any price. This industrial buying creates a feedback loop. Investors see industries panic buying. They interpret that as validation of the shortage. They buy more coins and bars. ETFs see inflows. The squeeze intensifies. The price gap's higher. There's also the speculative element. Hedge funds and family offices will see Russia's move as a signal. If a nation-state is willing to bet their currency on silver, maybe it's undervalued. Maybe it's the asymmetric trade of the decade. They start accumulating futures contracts. They buy miners. They push the narrative on financial media. This brings in retail investors, the same crowd that drove GameStop and Bitcoin. When retail enters silver in size, the volatility goes parabolic. History shows us what happens when monetary demand collides with industrial demand in a small market. In 2011, silver went from $18 to $50 in 4 months. That was driven mostly by investment demand and some industrial buying. There was no nation-state involved. Imagine 2011 on steroids. That's what we're looking at. But the most important factor is the paper market breaking. The COMEX and the LBMA operate on fractional reserves. They have far more paper claims than physical metal. When Russia starts standing for delivery, when they demand 100 million ounces of physical from the COMEX, the exchange faces a choice: deliver and drain the vaults, or default and settle in cash. If they default, confidence in paper silver collapses. The premium between paper and physical blows out to $20, $30, $50. At that point, the paper price becomes irrelevant. The only price that matters is what you can get physical for, and that price is $105 or higher. Russia's announcement isn't just about backing their currency. It's about exposing the fraud of the paper markets. It's about proving that the emperor has no clothes. The Western financial system has been selling silver they don't have for decades. Russia is forcing them to deliver. And when they can't, the price explodes. $105 silver is not a dream. It's the math. It's the unavoidable consequence of a nation-state entering a market that is too small to absorb them. In part 4, I'm going to give you the strategy: how to position, when to buy, what to avoid, and the signs that the squeeze has gone from theoretical to real. Part 4, the strategy: positioning for the explosion. If you've made it through parts 1, 2, and 3, you now understand the full picture. Russia has announced a silver-backed ruble. They need over 1 billion ounces. The market can't supply that without a massive price spike. The math leads to $105. So now the only question is, what do you do? How do you position yourself to capture this move without getting caught in the traps that will destroy unprepared investors? In this final part, I'm going to give you the playbook for the Russian silver ruble crisis. First, understand the timeline. Russia isn't backing the ruble tomorrow. This is a multi-year process. They need to accumulate silver, build storage facilities, create redemption mechanisms, and manage the political optics domestically. The announcement is the starting gun, not the finish line. This means you have time, but not unlimited time. The smart money is already moving. Rule number 1, physical only. I cannot stress this enough. If Russia's move exposes the paper market as fraudulent, the last place you want to be is holding paper claims. SLV, the popular silver ETF, holds metal in London vaults. If those vaults are rated by sovereign entities standing for delivery, SLV holders get cash settled at a price determined by a broken market. You lose. Physical coins, physical bars, stored in your possession or in allocated storage where you have title, nothing else survives a market dislocation. Rule number 2, buy now, not later. The amateur mistake is waiting for confirmation, waiting for silver to break $40 before buying. By the time it breaks $40, premiums will be $15 over spot. You'll be paying $55 for metal, and if the squeeze accelerates, you might not be able to buy at all. Dealers will be sold out. Mints will be on indefinite allocation. The time to buy is when the market is asleep, when silver is $32 and nobody cares. That's now. Rule number 3, diversify your source. Don't buy all your silver from one dealer. Don't store it all in one vault. Geopolitical risk is real. If Russia's move triggers a financial war, governments might restrict precious metal exports. They might freeze vaults. They might confiscate inventory under emergency powers. Spread your holdings across jurisdictions. Some in your home country, some offshore, some in your personal possession, some in private vaults. This isn't paranoia. This is prudent risk management when nation states are involved. Rule number 4, understand the exit. $105 is the first target, not the top. If Russia's accumulation triggers a broader move toward silver standards, if China follows, if BRICS nations coordinate, the price could go to $150, $200 or higher. You need to decide in advance what your exit looks like. Are you selling at $105? Are you holding until the gold to silver ratio hits 20-1? Are you swapping into gold? Are you buying land? Make the decision now before emotions cloud your judgment. Rule number 5, ignore the volatility. Between $32 and $105, there will be violent pullbacks, 20% corrections, 30% crashes. The media will declare the rally over. The banks will try to shake you out with margin hikes and futures manipulation. Do not sell. The thesis hasn't changed. Russia still needs the silver. The supply is still tight. The shorts are still trapped. Volatility is noise. The trend is the signal. Rule number 6. Watch the indicators. There are 3 signs that Russia's buying is accelerating. First, premiums explode. If premiums on coins go from $6 to $15 overnight, Russia just entered the retail market. Second, mint rationing intensifies. If the US Mint, the Royal Canadian Mint, and the Perth Mint all suspend sales simultaneously, that's a supply shock. Third, COMEX inventory collapses. If registered silver in COMEX vaults drops below 20 million ounces, we're approaching a default scenario. When you see 2 out of 3 indicators, the squeeze is real. Rule number 7. Don't leverage. The temptation will be strong to use margin or options to amplify your position. Resist. Leverage is how you get wiped out in a volatile market. You can be right on direction and still lose everything if the timing is off by a week. Stack physical, no leverage, no counterparty risk, just metal. Now let's talk about the scenarios. There are 3 paths this can take. Scenario 1, the slow grind. Russia accumulates over 5 years. The price rises steadily from $32 to $50 to $70 to $105. This is the orderly version. It gives you time to position. It gives industries time to adjust. It's the least disruptive, but also the least likely. Scenario 2, the fast squeeze. Russia's buying, combined with industrial demand and speculative inflows, creates a feedback loop. The price goes from $32 to $105 in 12 to 18 months. This is the 2011 replay. Violent, but manageable. Most investors who positioned early will profit. Scenario 3, the market break. Russia stands for delivery on COMEX. The exchange can't deliver. They settle in cash. Confidence collapses. The paper price and physical price decouple. Paper silver trades at $40. Physical silver trades at $120. Premiums go to $80 over spot. Dealers shut down. The retail market freezes. Only large players can transact. This is the nightmare scenario for unprepared investors and the dream scenario for those holding physical. I think scenario 2 is most likely, with elements of scenario 3 appearing at the peak. The smart strategy is to position for scenario 2, but prepare for scenario 3. Finally, understand the risks. Russia might fail. The silver-backed ruble might not gain traction. Internal politics could derail the plan. A peace deal in Ukraine could ease sanctions and remove the urgency. The price could stay suppressed longer than logic suggests. These are real risks, but the asymmetry is compelling. If Russia fails, silver might drop to $25, a 20% downside. If Russia succeeds, silver goes to $105 or higher, a 300% upside. That's a risk-reward ratio worth taking. Russia just announced a silver-backed ruble. The market is still processing. The price is still $32. The window is open. But it won't stay open forever. When premiums spike, when dealers go dark, when the COMEX vaults drain, it will be too late. The people who profit from nation-state moves are the people who position before the crowd realizes what's happening. Russia is betting their currency on silver. Goldman Sachs is warning clients about $5,000 gold. Central banks are buying at record levels. The debt spiral is accelerating. And now a major economy is demanding physical delivery of a metal that doesn't exist in the quantities they need. Silver at $32 is not the price. It's the last chance. $105 is not the top. It's the breakout. Russia just declared war on the paper market. And the only question is, which side are you on?